Michael Kurtz, Chief Asian Equity Strategist at Nomura, joins us on the show from Hong Kong to speak about his sense. Michael, good having you. You prefer rate sensitives, I believe, and Indian Central Bank has announced rate cuts on Friday. Do Indian financials offer value at these levels?
You know, it's a great question. If we look at the Indian banks, for example, overall, they're selling at relatively high premiums to long-term average. The Indian bank sector today is trading at about 3 times book, something like a 15% premium to its long-term average of 2.6 times book. However, Indian banks today are generating about 20% trailing ROE, and that compares to a long-term average of more like 12 or 13%. So these are stocks that don't, at least ostensibly or optically, look particularly cheap. But then if we look at the actual performance in terms of the return generation and the additional tailwind that you're likely to get in the rate-sensitive space and the cyclical space from further downside to Indian interest rates out over the second half of the year, then suddenly those stocks do look a bit more interesting even from a valuation perspective.
Oh, okay. Any other sectors that you like in India at this point?
You know, we continue to like names in the externally oriented sectors like, for example, the pharmaceuticals. So Dr. Reddy's is a stock that we like very much in India. In keeping with the rate-sensitive sectors, we do want to have some exposure to the domestic auto and tractor makers. So Mahindra and Mahindra is also very much on our list. And then some of the more domestic, less cyclical names are still on our buy list in India. I would note here, for example, ITC in the consumer staples space, and Z Entertainment also in media.
What have you made of the earnings season so far? Can you expect a pickup in earnings from here?
Actually, this has been a rather impressive results season so far in Asia. 60% through the results by market cap. We've basically gotten very inline results, so slightly above consensus, about 1% above consensus, and with year-over-year net income growth coming in at about 14%. And that's more or less in line with the Q4 result of 15% year-over-year, which was itself a pickup from Q3. So what we see essentially is pretty good momentum in year-over-year earnings growth and sustaining the improvements that were logged at the very end of last year. All in all, I'd say this is a pretty encouraging results season, and certainly no reason for investors to become alarmed by the earnings cycle as we see it so far.
All right. Thanks a lot for that, Michael.